This is market wisdom for traders. For forex traders, stocks, options, commodities, futures, equities, ETFs, cryptocurrencies, including Bitcoin and all the rest. You're advised to subscribe, share. You can contact us for account management and for training from any part of the world, online or physically, on 080 375 97085. This broadcast delivered by Tugbe Izogi. In an emerging market, the smart money is domestic, not international. I think that emerging market bonds are inherently unattractive. If all goes well, you get your coupon payment. But if the country defaults, you could lose all your money. So why would you ever bother? Buying low beta stocks is a common mistake investors make. Why would you want to own boring stocks? If the market goes down 40% for macro reasons, it will go down 20%. Wouldn't you just rather own cash? And if the market goes up 50%, the boring stocks will go up only 10%. You have negative asymmetric returns. It is what I call a pigeon and elephant trade. You eat like a pigeon and shit like an elephant. There are three things I like to see when I buy a stock: a favorable macro situation, a secular trend, and good company management. I always tell my new investors, you will lose money investing with me at various points in the year, and it will always be unpleasant when it happens. This health warning is crucial so that investors have proper expectations. I like and pick companies that are cheap relative to their sector, but where I expect positive earnings surprises during the next few years. We are always in the most liquid securities. If we get it wrong, we get out immediately. In controlling risk, it is also very important to have people in your team whose opinions you respect, who can push back at your ideas in a way that will make you stop, listen, and test your own views. There are multiple requirements for a trade to take place. Do we like the company? Is it cheap? Does it generate cash flow? Do we trust the management? Do I have confidence in my projections? Is the macro outlook favorable? If a company meets all the criteria, then the next step is determining the appropriate position size. Gut feel is actually crucial. If something isn't acting right, this is an indication that you need to go back and recheck the fundamentals. RSI is only useful in one direction, which is oversold. If the RSI is extremely oversold, I will then look at the fundamentals to see if whatever has caused the stock to be sold off that sharply is already discounted by the price. If it is, then I will buy. You have to be an expert in what you invest in. You need to understand why you are invested. If you don't understand why you are in a trade, You won't understand when it is the right time to sell, which means you will only sell when the price action scares you. Investors often miss the best stock because they can't bring themselves to buy a stock that has already gone up a lot. What matters is not how much a stock has gone up, but rather how well a stock is priced relative to its future prospects. In my experience, it is usually a mistake for a manager to alter his investment process to better fit investors' demands. This brings us to the end of episode 32 of Market Wisdom. Remember to contact us for account management training online or physically. You can reach us 080 375 97085, or you are advised to subscribe, share, like, and ask questions. Thank you.